Smart Home Advantage.
Sorry.
No,
I
you're
forgot
good.
to do that earlier.
You've got the Trust Smart Home Advantage program. You've got something called a 2-1 buy down. So real basic scenario. And the buy down, all it basically is interest that is paid up front, by the seller contribution. So right now, obviously, you're seeing a lot of seller contributions out there, builder contributions, on your new construction stuff. So, that's helping a client in a buy down. Basically, they get a rate. So, on say a very simple 2-1 buy down, if the rates are 7% today, their rate is going to be 5% the first year, stepping up to 6% the second year, stepping up to the nominal rate 7% the third year and beyond. So basically, who pays that interest? Who pays that interest, that difference? There's no such thing as the free lunch, right? So who pays the interest the first year and the second year? That's paid by seller contributions or builder contributions. So it goes that the interest, we calculate what that interest is. It goes into a separate escrow account per se that is paid up front by the builder, by the seller. That's an option that's becoming kind of more popular, for some clients, especially if they're ones that a couple of different clients that it works well for is one, they're thinking, rates are going to drop the next 2 years. So why wouldn't you do something like that? When you think rates are going to drop in the next 12 to 24 months, that's a great option for the seller to pay that lower, that for a temporary period of time, because you're thinking you're going to refinance anyhow. As I was going through with ACUF Weekly Group earlier in the week, some other scenarios that may prompt you if they mention, hey, I would really like this 350 house, but my budget, with the rates going up, I think I may just want to stay at 300. But because I got a car loan that's getting paid off in the next 2 years, and I think I need to be under 300. Well, a 2-1 buy down could make sense for that client. By the time that rate steps up and increases, they can go ahead and buy a 350 house today. By the time that rate steps up, that car has been paid off. Or if they're expecting a raise in another year or two, they're getting a raise in at the beginning of next year or whatever. By the time that rate increases for their payment to increase, their budget has now changed because of that raise or because of that car being paid off. So, I guess try to find out what the client's hurdles are, and let's see if we can come up with a solution to fix it. A lot of the money, there's a lot of incentives being thrown around right now. A lot of that, what I'm seeing that's being beneficial to the clients is obviously seller paid closing costs and contributions, whether that's to buy down the rate permanently, do a temporary buy down, etc. That's what I'm seeing being the most popular option right now, to get people over that hurdle. And even on some of my in-house programs where we're doing 100% financing, with the seller paid closing costs, those incentives, able to hold on to more of their money. Maybe they're not doing a buy down. Maybe it's truly just paying their closing costs. And maybe it's a client that just has, $5,000 to $10,000 in the bank, not exasperating all of their resources, having that money where they're able to save it and keep it in reserves. If they have to add a little each month to that monthly payment, if it's a little higher, makes them feel more comfortable with making that payment until maybe we get into a refinance situation. If you look at Fannie Mae, Freddie Mac, MBA, Mortgage Bankers Association projections, for every projections made, for every projection, someone's been wrong. So take it with a grain of salt. But if you look at their projections, they are saying that rates will, could potentially decrease in the next 12 to 24 months once we hit a technical recession type deal. The Federal Reserve will have to combat that if inflation gets under control. So, you know, take it as you may. But that's what we're seeing. You know, another great option that we're doing a lot of right now is we have some very, competitive ARM options. So don't get, if you Google search ARM or see these headlines from CNN or whatever, Forbes, whatever, you're seeing borrowers, the application rate for ARMs, reaches high, riskiest loans, what caused the 07-08 housing crash. So the ARMs have a bad rap because of what they were doing, and how it caused a crisis in 08. Those ARMs are completely different than they are today. The ARMs of 07-08 were more interest only ARMs. So I saw some of those interest. So somebody could buy a $400,000 home and do a interest only adjustable rate mortgage where they're paying $1,000 to $1,500 a month in interest only. Well, obviously what happens when there's a correction in housing prices and say in that case in 08, where prices may drop 10 to 20%, depending on where you are, the borrower, you're underwater at that point, because you were doing almost 100% financing, and you're not paying any money towards your principal. All you're doing is paying interest for a short period of time. Not smart lending. The banks, lenders, Fannie Mae, Freddie Mac, they've gotten smart. They've tightened down on that. And there was no limit. The rate could go up. If rates went to 15%, your ARM rate was 15%. Those ARMs are gone. Now the only ARMs, basically, I mean, you can find some crazy ones out there, but the only ARMs that are really that are out there productively right now are your fully amortizing principal and interest ARMs. That may save a client on a client with a 680 to 700 credit score. Again, that could save you 1% of your that could save you 1% of your loan amount. You may go from a 7.5% rate to, say, in our case, a 6.5% rate, because obviously there's pricing adjustments if you don't have a 740 credit score. So somebody with 680, 700 literally could save them 1% on a $300,000 home. That's, almost $3,000 a year in interest savings, $250 a month. And that ARM is fully amortizing, and it has a cap on it. So you're making standard monthly principal and interest payments. It's amortizing over 30 years, and the rate can only adjust. Say you have a 10-year ARM. That rate is for a full 10 years. The average life of a mortgage in the United States right now is about 5 to 7. The average life of a mortgage for a first-time home buyer is 3 to 5. So,
right there. So I'm going to interject real quick.
Go ahead.
Right there. So let's back into this a little bit. So you just, I think you just identified something really important. I think when we have questions with buyers, we're having like a consult, maybe it's a first-time conversation with a buyer. I think it's really important for us to, especially if they're a first-time buyer, helping them understand that this is a big decision, but it's probably not going to be their last home. So what are some questions or things that we can bring up to a buyer, Hudson, when we're kind of qualifying them to say, they're like, we really want to buy a home. We've been renting for a couple years. We've got good credit score. What's the next step for us when we talk to a lender? So what kind of questions are you asking them, and what should we kind of give them a heads up on before just saying, wait, just call Hudson?
Yeah. I mean, I'd be happy to talk with them through it, but basically have them start you don't want to scare them, but maybe have the conversation, maybe ask them, have y'all been saving any for down payment? Have y'all been, and if they've got some money, for reserves, if they've got some money for down payment, where I see the interest rates affecting people the most is your limited down payment buyers. The people that have the 5, 10%, 20% or more to put down, that's not really impacting them as much. That payment is really changing for your entry level buyers, who are, who put in the minimum, the 0 or 3% down, because then that's the interest rate affects them the most. Instead of affecting them 80% with a 20% down loan, it's affecting their whole payment, 100% of that. So, have that conversation. Have y'all started, maybe have y'all started saving? Do y'all have any saved up for down payment? That kind of thing. And then, like I said before, the budget thing, kind of, have y'all thought about what your budget is? If we, instead of finding a home, we're in a market, in a situation that we're in where rates have increased so rapidly. Let's have a conversation. Instead of rates have doubled, it's all doom and gloom. What are you comfortable with from a payment perspective? And then let's back into that number to see which programs they qualify for to determine their max purchase price. Another thing we're doing right now with seller contributions is a borrower that may have a 5% down payment and a 700 credit score. We can possibly put them on an ARM, like an adjustable rate deal, say a 10-year ARM for that first time buyer, 5% down. Put them on a 10-year ARM. The likelihood that that's their forever home is very, very slim to none. So why pay 1% over what you could get here? Why pay 1% over when you're not even going to meet the adjustment period? Now some people think that's forever home. A lot of times it's not. Like I said, the first time home buyers 3 to 5 years. Y'all would probably say it may be sooner than that, because y'all see in real life how these people are turning before you buy, sell, refinance, etc. Go ahead, Acuff.
Yeah, I would say that when helping a new buyer, we typically, especially in a market like this is where really we're going to push new construction pretty hard. That's kind of where we're at right now, is that we feel like if we are looking out for the best interest for our buyers, just as a whole, not thinking about just an individual person, but as far as like, what's something that we can go after that's going to attack, that's going to help our clients from a majority perspective. And so when I start looking at the pros of purchasing, I'm looking at the pros of purchasing new construction, because I know Hudson can speak to this as far as what kind of opportunities there are with concessions, with getting, and what we mean by concessions is getting their closing costs covered. Maybe the lender and the builder are covering some of the costs to possibly buy down the buyer's rate. So they're able to make pretty significant savings on a ever increasing market. And the builder is always looking at their inventory going, okay, how can we get rid of this? So like right now we're at November 10th. There's so many builders probably looking to get homes off their books by the end of the year. So now is a great time to go, hey, look, we've got 50 days to the end of the year. You could close something that's pretty close to finish right now. So the builder's going to go, hey, for like the next couple homes, we may be giving 15, 20 grand total in concessions to that buyer. So I would get really excited at this point and go to my buyers, or whatever buyers I have, or if it's even just a social media post, and be like, I have an absolute great offer for our clients going right now that and we can get you in by the end of the year and get you a great purchase, at a pretty tough market, because from a resale perspective, resales are looking at the previous prices over the past 6 months. So they kind of have a lagging price. That's why we see so many overpriced homes right now that are having to, go through the pain of being on the market, and then they're going to have to drop their price, and then they're just going to be chasing the market. Whereas the builder's going, hey, look, we know what's coming. We're going to go ahead and give you that incentive up front and help get your buyer in faster, because that's going to help out everyone in this situation. So we find that some of the best, as far as promotional items, if you're going to be pushing out emails, newsletters, Facebook, Instagram posts, stories, I would start having those conversations around new construction, because there's nothing better than having your own brand new bathroom or kitchen when you think about the owner. Do you have any questions about that, Roxanne or Kelsey or Judson, Carter?
No, not at the moment. It's been a really great discussion, though. I definitely learned a few things.
Another thing that we're seeing, a first time home buyer, and to put into play, obviously everybody knows, well, first, you don't have to have 20% down to buy a home. A lot of buyers don't understand that. You guys understand that. So educating that aspect of it, the average down payments, probably somewhere between 5 and 10% realistically average. And so that's, if somebody says, well, I don't have 10%, I don't have 20%, you're like most Americans, that's fine. That's why there's something called PMI, private mortgage insurance. They enable buyers to buy with less than 20% down. PMI is also one of those items that, PMI could be $100, $150 a month. PMI is one of those things that we can have the seller pay an upfront. We can do a seller paid PMI using some of those seller contributions to pay that PMI up front. So you combine that with, say, you got a first time home buyer 5% down, instead of saying, 30-year rates or 7%, with my 700 credit score, it could be my 30-year rate may be 7.5%, or I would, and I've got a PMI of $150 a month. We turn that conversation into somebody offering seller contributions or a new construction. Hey man, we can do a 10-year ARM at a percent lower rate, $300,000 house, save you $250 a month. Hey, let's have with no upfront, no additional cost to you, no points, no buy down. Hey man, the seller's paying $7,500, $10,000 in closing costs now. Why don't we do an upfront seller paid PMI? That's another $150 a month. You're all of a sudden talking about somebody who was stuck at maybe a $2,500, $2,400 payment that didn't want to go over $2,000. You save $250 a month on interest on the ARM. You save another $150 a month on PMI. You're now under your $200,000 budget just by maneuvering the situation. Changing the loan program, seller paying PMI up front. Now their payment is in their comfort range. So does that make sense?
Nothing gets Hudson more excited than shifting money around to save buyers, if you can't tell.
That's what gets me going.
That's awesome. That's awesome. So, I mean, a lot of those nuggets, and I just posted some of that into the chat, as you can see. So like, this is where like your creative side, if you're doing your own marketing, I think it's just really important that you got to start thinking creatively, like, how can I repurpose content? I like to call it R&D, rip off and duplicate. It's not research and design, right? So the best do this. So is finding the content that's working, right? So if the content that's working is telling people that, yes, the mortgage rate is 7%, but would you buy a home if you could get 5% today? Just asking that question, I think you would get a lot of eyebrows raising, and they would go, man, that's actually, and they may go to Bankrate or whatever it is online and run the calculator and go, actually 5% actually gets us within our budget, because they may be guarded, they may be holding back that conversation. So it's just really important to kind of focus on, how can we creatively get this information out there? You definitely don't want to be a secret agent about it. So, I think a great question, I put it in the comments, is that go on social media, maybe do a post or a poll, and say, what do you think the average down payment is right now? What we're seeing. And I'd put like 0%, 5% or less, 5 to 10%, 10 to 20, 20 plus, just to see what people are, because this is what's going to tell you what your audience is thinking. Because once you know what your audience is thinking, and then you'll also find out if they're going to be engaged in your content, or at least now you're starting to get the eyes on your content, you could start using this, and then, you know, there could be a follow-up post, or what we like to call a touch point, and you go, actually, the average down payment right now we're seeing is 5 to 10%. And where we're seeing that the most is in new construction. And check out these opportunities that buyers are saving incredible amounts of money. They're getting a fantastic interest rate that really fits their budget. And if you'd like to know more information about that, feel free to reach out to me. You know, that's how I would twist that into a lead. Like, if I'm always thinking, how am I going to funnel someone looking at my content that's not talking to me? How do I get them to have that conversation with me? So you don't have to be the expert, but you've got to be the person that is able to communicate what's going on, because, you know, it's hard to see what's going on behind the curtain when you're sitting in the crowd. So it's important you've got to be able to come out on stage and present, right? Yeah, that's just my marketing mind wrapping around this, but I think those are some phenomenal options that Hudson shared with us today. I'm trying to think of, is there anything else going on that you guys are seeing in the market with mortgages or opportunities there?
Yeah. Any questions? Do y'all have any particular specific maybe questions in general terms for me?
Yeah, trying to think. You know, we got a lot of our questions answered on Tuesday, which we do appreciate. I'm just trying to think if we can cover any of those items again. But yeah, it's there's a lot of good products out there. I think falling into the fear of the media is what's keeping a lot of people on the sidelines. And I think you have to be the breath of fresh air with the positivity wrapped around buying a home, and being the advocate, right? You got to be the advocate for home ownership right now. So it's very important, because even with an interest rate at 7%, it's still a better opportunity than just renting. You may have a little bit less rent versus the mortgage, if that's the case, but think about the amount of money that you're putting down towards the principal that you're going to be able to recoup on the back end.
So I had a client recently purchased a home. I helped her purchase a home a little over 2 years ago, I think. Obviously different environment, whatnot. It was kind of before rates took the deep dive. I think it was back in 2019, actually. So it's before rates took the dive. So she had an average market rate, you know, in the 4 to 5 range. Decided she didn't want to rent anymore, decided she wanted to buy. And, you know, came to me wanting to talk about, you know, upgrading. So we had to have the conversation with that, kind of where her payment looks like. She upgrades all that. And then she makes the comment, well, heck, I could rent. If I sell this house and get my money and get the money that I've made off of this, I could go back to renting. I said, hold up. What did you just say again? If I sell this house and get the money that I've just made, I could go back to renting for less than that. I said, okay, so what if you had been doing that the last 3 years? Your home value has increased from 130,000 to 165,000. With the pay down, you're going to make 40,000. If you sell your home, you're leaving with $40,000 you're about to make. If you had been renting, you're leaving with zero. Okay. Your exit plan is zero. So why would you want to go back there again? Does that make sense? And she's like, well, I said, if you had rented instead of bought that home, what would you have when you decided to move? How much would you have today? She said, I guess you're right. I'd have zero. I said, so you've just increased your personal financial statement, your net worth by $30,000 to $40,000 for your family, and so that really kind of hit home with her. Yeah, you may not, the timing when rates were low, you were saying, you can get a mortgage for less than you can pay in rent. That was true at the time. To Acuff's point, that may not be true today because of the increase in rates. But two of my favorite things that I'm hearing around right now, and realtors are doing a good job pushing it, is you're right. Renting, interest rates may be 7% to own. Renting, your interest rate's 100%. Okay, you're still at 100% because you get nothing out of it. So educating on that, and then another, you've heard it all. Another one of my favorite ones is marry the house, date the rate. We've all heard it. Don't think that's got to be your payment forever. That's a great point. It really is. If you think about it, it's a great point. You don't, if you like the house, if that's what fits you, if that's what you need, if the time is right for you, buy it now. Marry the house, date the rate. You can always refinance later, and potentially lower your payment. But if it's the right time for you, go ahead and buy. The right time to buy is the right time for you to buy, not necessarily everybody else. Your client, Mr. Client, the time, is what's right for you. So, all good stuff. I think there's so much negativity and you got to think everything that gets posted on Business Insider, Forbes, whatever, Apple News, it's all, it's all clickbait. They're trying to get clicks. People want to say historical mortgage rates rise to highest level in 40 years. They're trying to get you to click to read. That's not necessarily the case for every individual. So just be sure that they know there are options. There's options out there that aren't that scary, that aren't that, the best time for them to buy is when it's the best time for them to buy, not someone else. Every situation's different. Every buyer's different.
Nice. Any questions or comments anyone would like to put into any of this?
Yeah, I have something. I'm gonna walk out so I'm not echoing so bad in here. Hudson, I just wanted to give you kind of a thank you and like a pat on the back. The education that you gave us yesterday, I was able to speak to last night with a guy. I do like a Wednesday night bowling league. There's a guy that I'm just standing there having a conversation about the market and just options. And he said that, he's thinking about buying a house, but was wanting to wait because of rates and because the market and everything. And I was able to tell him a little bit about your, the 2-1 buy down and speak to some of the points that we talked about. So I really appreciate you taking the time and educating us and, just pouring into our group. So big thank you.
Absolutely. Happy to do it, man.
Anybody else? I know Hudson's got to move on to another meeting here shortly, so we're just going to tie this thing up. So is any last questions or comments from anybody? All right, I see Kelsey. Thank you so much for the helpful information. Well, I hope this was very relevant. I think this is because we covered a lot of the frustrations that people are experiencing right now in the market. So thank you, Hudson, for sharing. And we're going to conclude this Level Up Mastermind, and we will pick this thing up next week. So thanks for hopping on, everybody, and we look forward to seeing you guys next week.
Yes, sir. Thank
Bye.
you, guys.
Bye. Nice meeting everyone.
All right. See ya.
Thank you.